Welcome to Copytraders Club, where you can learn how to make more money copy trading. I'm Gavin McCauley, my name and username on eToro. You can continue the conversation on Discord and Facebook. If you like this podcast and you want to see it continue, you can do your part by recommending it to one person or group of people this week. Today is a Total eToro episode with three of copy trading's leading lights forming a mouth-watering panel. Here we go. Here we are with episode 40, where life begins, which explains my childlike enthusiasm for all things eToro. And today, we have a panel where three august invitees sit around pontificating on three key issues that affect us all as eToro users. Firstly, we have the subject of 1 million YouTube videos. Is a market crash coming soon? More importantly, what can PIs do to prepare? What can copy traders do to prepare? Secondly, we pick apart one of the most important elements of copy trading, and one, it seems, that nobody fully understands: desynchronization, the problems it causes and how to address them. Finally, we ask, Quo vadis eToro? What direction is eToro headed in? And how might they want to think about building the brand longer term? Three excellent subjects, and to deal with them, we have, rather appropriately, three excellent guests on the panel. Introducing the Michael Burry of the Balkans, he's making a name for himself on eToro, and, speaking of his name, don't get confused, he's not an asthmatic enjoying a specialist Thai massage. He's Gasper Soapy. Hello, Gasper.
Hello, Gavin.
Next up, we have a Frenchman Catalan bringing joy to this division of Copytraders Club. One part Peter Lynch, the other part Peter Hook. It's Hugo Menenti. Hello, Hugo.
Hi, Gavin.
And completing today's all-star panel, we have the very philosophical Felix. And we're looking forward, as always, to tapping into his Nietzsche reactions. Good day to you, sir.
Hi, Gavin. Great to be here again.
So moving swiftly on from those hilarious introductions, is a crash coming? What should cautious PIs be doing? What should cautious copiers be doing? Gasper.
Yeah, isn't that $1 million question? And I mean, literally $1 million question. Whoever can answer this, I guess, can make some bucks. But in all seriousness, I think there are two aspects of trying to answer this question. So one is the historic aspect, which is, I think in the last 50, 60 years, I think the S&P has corrected for about 40 times for around 10%. So, I mean, corrections are fairly common. They happen on average about every 2 years. And this is healthy for the markets, right? In terms of speculating about the future, this is sort of a sketchy terrain that I'm not so enthused to traverse or to try to engage in speculation. But I have to say that, considering some of the valuations and some of the froth that is appearing in certain sectors, it's kind of starting to smell like trouble in the way that I see it. I don't want to come across as bearish or a market bear or whatever, but I just think that it's a good time to be a little bit cautious. I myself am positioning in a way that some of the key positions have already had their sort of heat taken off, and I'm trying to position in assets and in stocks that have been somewhat depressed in terms of valuation, just so that I manage risk. So that's kind of a quick take on whether the market crash is coming. I think a lot of the last 18 months or 2 years have been, the markets have been sort of propped up by the liquidity and expansive monetary policies of the governments around the world. And I think we're seeing some of the signs that this will start to wane off a little bit. And I think the markets will start to pull back with liquidity. So I think the liquidity is being the primary fuel for the markets. And then when this starts to dry out, I think some of the valuations are going to look for some places to correct and to land.
So, Gasper, can you give us some precise details about what you've been doing in your portfolio to prepare for such an event?
My long-term strategy isn't actually swayed by trying to time the market or trying to guess what the macro situation is going to be in the near term or in the sort of midterm. So my approach to investing is to always invest in companies that I feel have a predictable cash flows, that are companies that create products and services that people love to use. These are companies that I know, and I try to stay in my circle of competence. I think the traditional investment wisdom has proven again and again that time in the market trumps trying to time the market. I think all my investment mistakes that I've made in the past 10, 11 years that I've been in the investment world have always had something to do with selling or trying to hedge or trying to figure out where the market is going to be. So I think in that sense, my risk management is to position in boring stocks. Some of them have fallen out of grace or are being depressed because of some external factors, like for example, geopolitical headwinds. China comes to mind. So currently my biggest position is in Alibaba, and I try to seek a margin of safety in the valuations as well as in the future growth prospects. And I plan to stay invested. So I think just holding on through difficult periods is the way to go for whoever is interested in long-term compounding of their portfolio and wealth building that is beyond just getting rich overnight.
Yes, you say staying invested. I just checked your portfolio. I see 1% cash. You're not keen to build up a larger cash position, as some PIs are doing?
Yeah, I think my portfolio, I think, is positioned in stocks that, as I said, have been depressed in terms of valuation, or at least my analysis has pointed to that. And in that sense, of course, markets can always prove me wrong, and markets can always, crash. And when they do, they kind of tend to not discriminate across assets, so people start to sell off then indiscriminately. But I do believe that I've paid some efforts to identify these assets that have taken the heat out of them, and I feel that currently the portfolio is positioned structurally from the bottom up, has that margin of safety, and I don't expect it to be hit in case of any adverse market correction. But then again, you never know.
I would say my overall philosophy, is to realize that since World War II, markets have gone up more than 70% of years. So I'm much more focused on making money rather than avoiding losing money in the 30% of years where it goes down. And I think that's what all investors should do. So I think at my core, I invest in companies. I'm not a macro investor. I don't worry too much about risk management and portfolio management. I do, but I first and foremost invest in companies which I think are going to do well in the medium and long term. So the way I go on about worrying about potential corrections or market crashes is to sort of stress test the portfolio from time to time. What happens if there is trouble with China? And I look at what companies in my portfolio would be impacted and the sort of impact it could have on the overall portfolio. Or what happens if there is a sort of debt crisis and yields go up in a peak? And then looking at the impact of that. And I guess it helps me sort of manage the risk within my portfolio, look if there is any imbalance anywhere. But yeah, apart from that, I don't want to worry too much about crashes because realistically, they tend to happen when you least expect it. COVID, no one really saw it coming. Some people did, obviously, but the overwhelming majority of people didn't see it coming. The great financial crisis, 2007, 2008, a couple of people saw it coming, but mostly no one did. It's the sort of like black swan events that you can't really you can't really time or you can't really plan for. So make sure your portfolio is stress test, diversified and balanced, and worry about making money rather than avoiding losing it.
If I could give my tuppence worth, I agree with all that Gasper and Hugo have said. There's definitely strong merit in staying invested in the market. One thing that is unique to eToro is that since we've got copiers, even myself has some, they don't necessarily react to crashes in the same rational way that we might do and able to hold through them. So there are different strategies you can use. One of them would be to have a ton of cash on the side, but I don't really like the strategy basically because generally speaking, it's going to cost you money by having that, and you end up looking back and you might lose less when there's a crash, but you'll make less on the way up. Second tactic, which I actually do like a lot more, is having a more all-weather portfolio. There are some PIs like Slow and Steady, Baltic Seal, Shea 0327 who do this. The upside is that they really ride out the crashes a lot better. The downside is overall they don't make anywhere near as much. So the third tactic is what I use personally for my portfolio, and that's kind of hybrid. I've got 5 stages that I would do if there's a crash. Number one is to use my available cash. I don't have that much, probably 5%, not even that much at the moment, but roughly 5% cash. Secondly, is sell non-correlated assets. I do have some gold, silver, Bitcoin, and Treasury long-term bonds, so could sell some of those if they haven't also dropped. Third thing is to sell stocks that haven't been hit as hard. So, for instance, Coca-Cola might not be hit hard. Sell that and buy the dip in Facebook or Alibaba or whatever it may be. Next one would be to sell lower conviction stocks, even if they're at a loss, but using them to fund higher conviction ones. So I might sell Spotify at a loss and then put that money into Nvidia or something if there was a crash, just because I have a higher conviction in Nvidia. And fifth tactic would be just wait it out. If I've exhausted the first 4, which thankfully hasn't happened yet, we just wait until it recovers. A sixth tactic, which I'll finish on, would be to make a deposit. But again, on eToro, we have to bear in mind copiers, and that's not so much of an option. But if it wasn't on eToro, then that would be making a deposit would definitely be one strategy to use. So that's my kind of 5-step process for dealing with a crash if and when it happens. So I'm sure it will happen sooner or later.
Well, those are 3 views then that are all quite similar or share a lot of common ground. You say you would consider putting in a deposit if it wasn't eToro. The equivalent surely on eToro, or to some extent there, therefore to make sure you've got some available cash, is to free up some cash, which is an alternative approach. I saw recently CPH Equities said on a recent call that he's keeping, or that he was in September, keeping up to 30% in cash for this very reason. And he has deployed some of it in the late September dip, and he's still on about 18% of cash.
If I could just answer that one, I'll tell you the difference between injecting cash or having cash is on the way up, CPH equities will not make anywhere near as much by having that cash. Whereas the benefit of injecting the cash in is you make the full benefit on the way up, then you put the cash in, and presumably you make the benefit after the dip. So it'll hamper his stats on the way up if we are going to still go up.
If you're a copier, what's the worst thing you can see your PI doing?
Well, one thing would be selling their entire portfolio and panicking, not mentioning any names. Another thing would be doing things like highly leveraged NASDAQ shorts. There's sort of like an overreaction. I think, oh, we're in a crash here. And then when the NASDAQ's maybe 5% down, they'll go 20 times leverage shorts of the NASDAQ or the S&P, and then claiming to know that, oh, this is just going to be a 5% or a 10% dip or 20%. But I think none of us know that. So that could be highly risky, and often it's closing the door after the horse is bolted. The market's already maybe down by 10%, and then they open a short position. Well, in those positions, I would be opening a long position. That'd be the times when I would be wanting to go more long if I had any assets or residual cash. So that I think is the worst thing is panicking and either selling a whole bunch of stuff or using leverage.
I agree with a lot of what Andrew just said. I think what I wouldn't like to see is overtrading. Someone chasing the market, running after the market. So it goes down, you start shorting, and then it goes back up, and your short is losing money, or selling stocks without any clear strategy. We've seen a lot of that early this year when small caps started to crash a little bit. Or you've also seen people starting to short the market at the end of March 2020, making a little bit of money on those shorts, and then they stay short the whole of April, May, June, and lost a whole lot of money on those shorts. So I think overtrading and running after the market is the main thing that I wouldn't want to see a PI doing. I think what I would want to see is someone with a clear plan, free a bit of cash and buy at the bottom, or even do nothing. I mean, doing nothing is absolutely fine, I think, in a correction. Much better than overtrading.
I think for a lot of eToro users, March last year was perhaps the first crash that they've experienced. And it was very quick and a very quick recovery, really. Do your answers change if it's a much slower demise and a much slower regrowth?
I don't think it would. I think on average, if you short the market for too long, you're going to lose money. If you've got a differentiated view and you short early before it happens or at the beginning when it happens, then it's kind of okay. But you never want to stay short for too long because you're going to pay fees and the market eventually is going to rebound. So apart from a very tactical short trade, no, I don't think I would advise it.
Something I see on eToro quite a lot is people, even when there's a slightest dip, like 2% down in one day, people are saying, right, I'm getting in there and buying the dip. There seems to be an assumption that the market will immediately recover the way it did last April. And that's not always the case, as historians of the stock market will see in 2008, or especially the year 2000, when the dot-com crash, essentially it took the NASDAQ 14 years to recover to get back to its level. Because that's not happened in the last 10 years, any dip has just been very transitory. People have got in a kind of false sense of security. So I think that not using shorts and or anything that attracts fees would be good, because that would get you through a long, prolonged bear market as well as a short one. Whereas if you're going to short the market, that's fine if it's a short dip and recovers quickly, but it's not so good if it's a protracted sideways period.
Okay, so far we've been talking about what PIs can do in the event of a crash. Let's talk about copiers. If copiers are nervous, less experienced, copiers aren't the calm guiding hand at the tiller like you guys might be. So let's think about what a nervous copier might want to do. Are there steps a nervous copier could take to prepare for this event?
I think the copiers should be cautious to impulses to overtrade. They should try to resist overtrading. Just paying attention to the news media and being exposed to all different opinions across the internet and panicking and trying to time the market is probably going to hurt more than an eventual crash. Holding on to the assets that they have, holding on to investments which they know, staying within their circle of competence, understanding why they bought what they bought, understanding why they are copying a PI, making sure that they've done some research, and not paying attention to the pundits and not watching a million of YouTube videos where people make money by just accumulating clicks and sort of trying to create an atmosphere of fear, uncertainty, and doubt. So I think that's what I would suggest to copiers as an attitude, for any eventual market crash or any correction.
Sounds like wise advice. Anything to add to that?
I think one thing that every copier should do is to figure out, before investing, what's your goal, what's your time horizon, and attitude to risk. Once you've got that figured out, then you can decide your allocation between PIs. And that allocation should reflect really your goals and your attitude to risk. And so you should write that on a piece of paper. And whenever there's a crash or a correction, you should go back to that piece of paper and read it to remind yourself of why you're investing behind the PIs that you're investing behind. And besides that, I think just monitor your PIs, make sure that they stay in line with their strategy, make sure that they don't do anything rash without any kind of explanation, and potentially add a little bit of money to your copies if you have some spare cash. Besides that, if you're feeling nervous, I would say close eToro and have a walk in the park. That's what I do.
And Hugo, when you say add money, you mean not immediately. Crashes take often many months to get anywhere near the bottom. I'm not saying you can always time the bottom or anything like it, but there's no need to react immediately. Isn't that correct? You would be well advised to take your time. If you've got some funds that you could put into eToro, maybe keep an eye on how things are going. And if you can use that money then to profit from lower prices and you buy into your PIs when all their portfolios are at a low ebb, then that will see you gain significantly more as the recovery begins.
Correct. I think those copiers that do add funds every month, for instance, should absolutely continue to do so. It's always difficult to time adding funds. It's like trying to time the market. But if your PIs say, for instance, that it's a good time to add funds, then you might want to listen to them. I mean, I try to do it, No one has a crystal ball, but sometimes we have a good views based on technical analysis and macro analysis of when the market is bottoming and not. So I know that when I sense that there's a bottom based on my analysis, I say to my copiers, well, now is maybe a good time to add some spare funds if you do have them. At least that's what I'm doing.
I think the absolute best thing copiers could do in advance is copy more than one PI, preferably ones that are not correlated. For example, there's some really good PIs such as Mr. G, 23, Fund Manager, ZEC, Elite Vol. They potentially wouldn't lose money at a time when stocks were crashing. So we can mix them in. And the absolute worst thing you could do is to stop copying a very good PI when they've had a losing month. And you saw that last month in September. I mean, I'm sure Gasper and Hugo will have experienced that. Some of their copiers bailing out at the end of September and then missing the gains that you've had in October. So those are the best and worst things I think that people could do. But as the gent said, one thing to do is keep an eye out for any PIs who are behaving erratically, because sometimes you might need to pull the plug if a PI has abandoned their strategy. So there is always an exception to every rule, but generally the rule would be do not ditch the PI when that PI is having a losing month, assuming overall they're a winning trader.
Ultimately, I think if you're going to play this investing game, there will always be corrections and crashes. And I think we can leave this topic with some comforting words, paraphrasing a famous quote. Remember, listener, most of the time the world doesn't end. Let's now delve into another subject with myriad issues that cause upset and anxiety, but which, thankfully, do have a range of actionable steps to resolve them. So, what is this subject, I ask? Is it A, toilet, B, shower, C, bath, or D, sink? That's right, listener. It's desync. Copy desynchronization. Problems and solutions. Let's hand it over to the artist currently known as Felix Felix.
Thank you, Gavin, for that eloquent introduction. Firstly, I'd like to define desynchronization, and my definition would be anything that causes copier's performance to differ from the person they're copying, in this case, a PI. And I've actually been researching this topic, and I'll be releasing a couple of videos on this in the coming weeks. But when I was researching, I found 9 different types of desync and 9 factors. But to keep this brief, I will concentrate mainly on the most common 2 situations that will cause desync. And these can range from very minor to very significant, depending on the extent of the problem. It also doesn't necessarily mean worse results. It could actually work the other way, where you get better results than the PI. So what I'll do is I'll run through what I consider to be the problem, and then maybe Hugo and Gasper can input on what they perceive the solution to be, and I can also give you my ideas on the solutions. So the first type of desynchronization is copying for too small an amount to match all trades. For example, if the PI says that the min copy size for them is $500 and you copy for 200, what will usually happen is all the trades will not open, because if you copy for 200, then any position smaller than 0.5% will not copy properly. And you'll often see copiers asking, how come I've just copied you, but I've got a ton of spare cash, the trades haven't all opened, and 9 times out of 10, this is the reason. The other reason is normally the markets haven't opened yet. So that's the first problem, is copying for lower than the minimum amount that the PI suggests. And the second problem, which is what most people maybe think of when they think about desync, is the way the eToro copy trading system works. And it's to do with the originally invested amount and the current amount. So I'm going to give an example. Imagine a popular investor has 10% of their money in Bitcoin. And over a period of time, that grows to 20%. So 10% has grown to 20%. Their Bitcoin's doubled, assuming the rest of the portfolio is static. And you copy them. So the question would be, do you get 10% of Bitcoin or do you get 20%? Well, the answer is you would get 10% of Bitcoin. And you can see the problem here is that you would have 10% and the PI has 20%. So if Bitcoin was to double again in value, the PI would gain 20% and you would only gain 10%. And this is a problem that cannot be fixed at the copier's end. It can only be fixed by the PI or prevented by the PI. And as I say, it works both ways. Sometimes you'll benefit from it. So that's what I perceive to be the two main types of desync, is the copy trading amounts and this difference between the original and the current value. So before going on to solutions, I think it'd be great to hear from Gasper and Hugo and Gavin himself as to how they think it's good for a PI to resolve those issues and prevent them from happening.
Yeah, so the way that I've been dealing with that is basically just pay attention that if a certain position moves too far away in either direction, either gains or losses, then I will try to reset it. So that means closing it down and then reopening again as soon as possible. However, I think this is at least to my knowledge, this is the only sort of way to maintain sync. Of course, just make sure that I'm communicating with copiers and making sure that if I add cash, I lead them through the process and encourage them to follow my strategy and follow my advice in the sense that they should be copying up open trades when they top up, etc. That's the approach that I've taken. I think this would be best handled for eToro to introduce the option for copiers to choose whether they want to copy with a value percentage or with an initial invested percentage. I think that would kind of fix the problem both for the PIs and for the copiers. Having to reset the positions, creates a few issues. It creates taxable events. You kind of sometimes lose out on fees, on spreads. And I think that sometimes there can even be situations where, if you close the copy, you're thinking like, oh, maybe I should just, I should close it at a loss and then I just, just leave it there and take the loss and not open it up again, which, can backfire. So in a sense, the more I have to deal with the platform, I feel the more it's encouraging me to overtrade, the more I am susceptible to potential mistakes and to having those unconscious biases sneak in. So that's kind of the issues that I'm seeing currently now.
Yeah, I agree with what Gasper just said. The way I do it is, I think for my larger positions, I try to make sure that they don't run away more than 20-25% of difference between the actual percentage and the percentage invested. I give a bit more leeway to the smaller positions because they don't really make much of a difference. And whenever I had to add funds to the portfolio, then I did a full reset to make sure that everyone was in sync. But as Gasper said, the issue with that is, one, tax. And you have copiers from 50 different countries with their own personal situations, and it's impossible to manage. And two, fees. It costs 0.1% every time you close and open a position. And it adds up to something at the end of the year. And on top of it, obviously dealing with questions. I've had people asking me about bed and breakfasting in the UK. I've had people asking me why I was closing and reopening the same position. People adding the wrong amount of funds and asking me why the portfolio was not in sync. I mean, there's a whole lot of maintenance that we PIs need to do to answer questions. If you sum it up, it's a bit of a headache for us. It'd be much easier if the copiers were able to copy the percentage, the actual percentage of the portfolio rather than the percentage invested, or at least had a choice. But, I'm not a techie, so I don't know how difficult that would be. I just do the best with the hand I'm given. And, it's not perfect, but still works pretty well on average. I have a few copiers that I know, family members or friends, and I check their portfolio regularly to make sure that their returns are the same as mine. And it works, pretty well, actually.
So you all seem to be agreeing that it's a bit of a headache, but it's worth doing. That's not a view shared by everyone, of course. I don't know if you heard the recent episode with Capital Gains, but he was resistant to the idea of closing and reopening and said he wasn't interested in doing window dressing on his portfolio. What's the worst that can happen if you don't take the steps that you're talking about?
One point I always make is that even if you take eToro out of the equation, if you're managing a portfolio, it's generally a good idea to do some level of rebalancing. Like if you originally decide to put 10% of your portfolio in Google, and a few years later Google's worth half your portfolio, you might want to consider pruning that down. The only difference is if you were outside of eToro, you could just sell some of your Google, whereas in eToro, you actually have to sell the whole lot and buy it back again to bring those two values into sync. But there are a lot of complexities. I'll cover this in my advanced video, and crypto tends to be the most problematic one. I'll explain just briefly 4 problems with doing this with crypto. Problem number one is when you sell crypto, crypto's actually got a round trip spread. So, say on Ethereum, the 1.9 spread is applied when you sell it, not as well as when you buy it. So, if your Ethereum's went up by 4,000%, that is a hell of a lot of money is going to come off. And then secondly, if you try and buy it back, ideally you'd like to buy it back at a lower price, but you're buying it back with a 1.9% spread. It's going to be difficult to get it back where you sold it. That's problem number two. Problem number three, which both Gasper and Hugo said, is it's a taxable event. And in case of something that's run by thousands of percent, that'll be a lot of tax. Problem number four, which no one's mentioned, and I never have mentioned on my videos, but this is a really interesting one. Imagine in the situation I just gave you above, where you've got 10% Bitcoin, it's grown into 20% Bitcoin, you have zero cash. You sell the Bitcoin, you now have 20% cash. Your copier only has 10% cash. You then allocate that 20%. The copier hasn't got 20% available funds to match that. There's a knock-on desynchronization. That's how complicated it gets. As I say, I've got another 7 types of desync. That was one of them there, where the available cash is different, and it can get really, really complex. I'll cover that in my advanced video. But I think just overall having a cognizance of don't copy a PI for lower than the amount that they say on their bio. And secondly, either don't copy PIs who have got this huge gap between the original and current values, or on the other hand, do copy them, but be aware that results will differ, sometimes quite drastically. There, I'll give you, you can edit this out if you want, but I'll give you one worked example, no names. There's a PI recently who is saying he believes that Tesla will overtake Microsoft's market cap within the next few years, and currently Tesla's about a third of the market cap, maybe more like 40%, 45% now. Anyway, he thinks Tesla will overtake Microsoft. And he personally has a lot more in Tesla than he has in Microsoft, but copiers of him would be getting more in Microsoft than they get in Tesla. So by definition, by his own definition, they would be getting a suboptimal portfolio which had more Microsoft than Tesla. So that's the level of problems it can cause. If you consider what would be the optimal allocation, someone who's desynced, either they're not optimal or you're not optimal. You cannot both be optimal allocation, assuming that there was some robot that could calculate what the optimum allocation was.
Because the way it works, you can have 10% invested in Tesla, which has grown to 70% of your portfolio, and your risk score would be based on 10% of Tesla rather than the 70%. So that the way it's calculated creates a sort of disincentive to synchronize your portfolio, because if you did so, and you'd be with 70% invested in Tesla, and your risk score would completely blow up.
Yeah, you're right, Hugo. I actually meant to mention that on my crypto example. That is by far actually the main problem, is if someone had a huge amount in Ethereum or Bitcoin, sold it and bought it back in the large amount, their risk score goes through the roof, and put them over risk score 6, PI payment would stop. Problems. So there's another one. So it is, on the face of it, simple to sell and rebuy, but in practice causes a lot of headaches, a lot of new headaches. So it's a matter of keeping on top of it before it gets to that stage, I think, would be one way to deal with it.
So you have to, as you say, constantly be at it in order for it not to become too big a problem.
The problem is if you're constantly at it, you're denying yourself returns. I mean, probably the best returns it's possible to make in investing is letting a position run to hundreds or thousands of %. But if you're constantly rebalancing, you will knacker yourself. And unfortunately, that's what I've done with my portfolio. But at least the copiers are synced, so it's not all bad.
Yeah, I can totally relate to that. I think that happened to me, like coming into 2021. I was overweight on crypto, and then basically because I was getting inflow of copiers, some of them were getting really desynced, and then I had to take chips off the table, close the positions. Then I had the problem with the excess cash, so I ended up eventually having to reset the whole portfolio so that everybody was in sync. But I denied myself of incredible gains. If you look at Ioni's portfolio, he's like 30%, 40% in crypto. And just because he's been holding it for long, and I was also, my positions were like 2-3 years old. I was faced with this ethical conundrum. Like, should I, maximize my own interest or the interest of the copiers? And so I felt that, the middle ground would be just to rebalance the portfolio. And then, of course, like getting back to my initial allocation or initial value of the investments of crypto would have taken me to a risk score higher than I would want. So that's a real pain there.
Yeah, actually, the day you become a PI, eToro should make you sign a paper where you promise to manage your portfolio for the interest of your copiers rather than yourself. I don't think they do, but this makes me think that they really should.
I think one thing that's regrettable is that PIs like yours, both of you, who do manage it in that way, are at disadvantage against PIs who just don't give a toss and they'll let their positions run. And people will see their graphs are ostensibly low risk when we know it's not low risk because the risk based on the original allocation. It looks as if they've got really low risk, really high reward, when in actual fact they haven't. And Yoni, you mentioned there, is probably a prime example of, it seems extremely diversified, but in fact, half of his money, more than half, is in Bitcoin and Ethereum. But because he hasn't rebalanced, it looks fantastic. And most copiers will just go with the one whose graphs look fantastic. So by considering the copiers, you are actually damaging your chances of getting more copiers, which is, as Gasper said, a real conundrum to work through.
That was spot on. That's exactly what the problem there is. Absolutely.
I'm sure the forthcoming Felix Felix video will be to coin a phrase, gold standard. But if anyone wants to check out videos right now, Wesley's done a pretty good one. And of course, there's Victor Zhang has 2 videos, Get in Sync or Get Out, which break it all down. That concludes a great chat on one of the key issues of copy trading and one that so many fail to fully grasp, mostly because it isn't really explained very well, if at all, to new users of the platform. Dear listener, just a little pause here to say a few things directly to you. The calendar is full until the end of the year. That will mean 52 episodes, which seems like a good time to pause and call it Season 1 and take stock. It's been a lot of fun and a lot of time and effort, but I'm pleased to be creating something of value for eToro users, particularly copy traders. Whether there will be a Season 2 depends on a number of factors. I say it elsewhere, but I want to repeat it again here to really encourage a little action from you. If you want to see the podcast continue, you can help by bringing more listeners in. A lot of people still don't know about Copytraders Club, so post about it on your PI's feed in eToro. Mention it on a Facebook group, or in whatever Discord groups you're in. That's not too much of an ask, is it? On the podcast apps, there's always a share function that includes copy link. Use that. Or copy the YouTube channel link and share that. Or share a link to your favorite episode. There are many ways to eat an orange. I also have one of those affiliate links for new eToro signups in every episode's show notes. So, if you know someone interested in signing up, please copy and send them that link and help support the show that way. Now, I know these calls to action that you hear on podcasts can easily be ignored, and I always ignore them myself, let's be honest. But this time, I am asking you, as someone who listens to and enjoys this one-person independent podcast, to make a little effort to help it along. You can even press pause and take 2 minutes to do it right now. If you do, know that I am grateful. If you don't, every time you hear this bit, you will be overcome with a crippling sense of guilt and unworthiness. Until you do. Back to the show. On that bombshell, we'll move to the third of our 3 topics today. How eToro might want to think about building the brand longer term. Now, I'm sure each of us have our thoughts on this, but Hugo first.
Thank you, Gavin. I think I should start by saying that I'm a huge fan of eToro, and I totally share its mission and vision, and the whole democratization of finance and investing. What they're doing is great. And I think it's important to say it because we're talking about some of the pain points, but we shouldn't lose sight of the bigger picture, which is the money we're making, the things that we're learning, and the people we're meeting on the platform. And I think that's a good segue into the topic that I wanted to discuss with you. Trying to adopt the point of view of a copy trader. I think eToro is walking a bit of a fine line between 2 things. One is the whole crypto meme stock mania, which is very profitable to them. Profitable to people in the short term, but potentially dangerous longer term when the whole bubble bursts. And on the other hand, there's the more traditional, I would say, side of finance, which is investing in the stock market, the normal stock market, should I say. Popular investors, which sometimes have a professional background. And so I think eToro is trying to balance those two elements, which is one, meme stock, Wall Street bet crowd, making lots of money, being very active and disruptive. And on the other side, a more, I would say, traditional, controlled way of investing, of which the PI program is a good example. Controlled risk, limited leverage, the risk score, trying to get good educational materials for copy traders, making sure they know what they're doing, making sure they don't lose money. All the words of caution about using CFDs and leverage. And so those 2 things can seem a little bit at odds at time. And I think there's a sort of inner conflict within the eToro brand and their whole mission of what they're doing. And so I find that sort of inner conflict quite interesting, and I like to see how it resolves. I think we've seen in the past few months the cons, I would say, of the whole meme stock mania, particularly on the news feed, where some people have been abused, where we've seen some bad words and bad behavior from some other people. But, I'm not here to criticize it because it's also bringing a lot of people to the world of investing, to the world of finance that probably wouldn't be here without it. But anyway, I kind of wanted to put the topic on the table, and I wanted to ask you guys, what do you think, eToro should bring in terms of improvement to the platform, improvement to the communication, the PR, or internally with the users to make sure that the sort of balance between those 2 trends is kind of respected, and to make sure that people get the best experience out of it.
Good points, Hugo. That was really insightful. Yeah. So just to follow on what you were saying, I think for any brand, their customers are the biggest brand ambassadors. So you can plow a ton of money in building a nice shiny brand, but if the customers aren't happy, then all that money will have a poor return on investment. So I think it's quite important that eToro pays attention to both the UX experience of the platform, to make sure that they provide the right tools for PIs to manage their portfolios and add value to the community, as well as allow copiers and other investors, individual investors, tools to maximize the learning from the PIs, to introduce ways that good content can surface up from all that content that appears on the platform. Because I think it's I think just the sheer numbers of users that have amassed on the platform, that can be a very strong force for good. And it's an amazing opportunity to educate people how to approach investing, how to think about the world, how to maximize their well-being, both financial and otherwise, by investing their money, by learning about the magic of compounding. And then there's an opportunity for those people to go beyond just trading SHIB or Flocky or whatever, and just getting a couple of $1,000 overnight, and really be exposed to the content that the PIs can provide, and to the content that the community between themselves can also share and grow and learn together. So, I'd love to see eToro work on those kind of tools, on those aspects. I think the actual trading mechanics is fairly straightforward. And I think the next step would be to improve the knowledge exchange, to provide the tools where good content can surface out and that people can share it and can filter out the wheat from the chaff.
You're absolutely right that there are users wearing many hats on eToro. Individual investors, crypto people, copy traders, and it's very difficult for the platform to be all things to all users, which is where the suggestion of a self-curated news feed, I think, comes in very strongly, where you click to follow certain PIs or certain tickers, and therefore your news feed does become what you want to see. And the news feeds will be markedly different depending on what kind of user you are. Me as a copy trader, my news feed is going to look very different from somebody who's only interested in Shibu, for example. Do you think that's a change that's on the to-do list?
For me, 100%. There's a lot of intelligence and knowledge on the eToro platform. I think eToro users have just a wealth of knowledge. I would love if eToro could do more to make everyone benefit from it in terms of self-curated content, as you just said, or also working on the algorithm a little bit to make sure that the best content is promoted. Like you can have on other platforms, if I think Twitter, for instance, where you can see the really good content popping up. If the newsfeed of eToro looked a little bit more like Twitter, for instance, I think it would be a great thing.
Yeah, I've got some views on this. In terms of what interests me is attracting people to the site, and I guess as Hugo touched upon, there's kind of various types of customers. Some of them are ones who are higher risk speculators, and they certainly seem to have made their way to the platform, as you'll see on the newsfeed. Whereas I think maybe more work needs to be done in the people who are more risk averse, and also females, and that probably is a crossover between those two groups. And Gavin's discussed on his podcast that there aren't anywhere near enough females on eToro or female PIs. But also, even one of my work colleagues asked me the other day, and he's male, about joining eToro, and I explained roughly how eToro works and copy trading. And some of the first questions he asked me were, how do I know that this PI is not just going to blow all my cash, just go crazy one day and throw it all away? And obviously, as we've seen, this potentially in a rare case could happen. And I had to explain to him some things. As first of all, eToro do background checks on their PI, of their credentials. Secondly, we can see their track record on the bar charts and line charts and stuff. They could obviously be improved, maybe go back further in terms of risk score. We can also see someone's risk score for last year, which is reassuring. PIs can't go above a certain risk level. We can set a stop loss. My colleague was really interested in hearing about that safeguard. And eToro itself is regulated by FCA and SISEC. So I think it's just to attract lower risk investors, eToro needs to try and reassure people that although eToro is very different from a high street bank. Most people, if they're thinking of doing shares, they'll just use their share account with their high street bank, which charge terrible commissions, all sorts of fees. You're paying money per year to have a share account open. eToro is such a great site for keeping fees and commissions to minimum or to zero in case of commission. So it's really trying to attract these low risk investors. And just my final point on that is you can see by the PIs, there aren't that many low risk PIs at the very top level. I highlighted Slow and Steady, Baltic Seal last year, but there aren't really very many of that profile. So many of the top PIs, as you might expect, are people at risk 5 and 6 who are making high percentages. But I think there must be a market there for people who are just happy with maybe a 5 to 10% return as long as the volatilities get low. And eToro at the moment doesn't necessarily seem to be positioning itself for those type of people, either consciously or maybe just those people are harder to attract.
Well, one way to attract lower risk users for eToro might be to encourage a network of independent commentary, which shines a light on PIs and lets you get to know them much deeper than the platform itself.
Absolutely.
Great idea.
Yeah, but I think that sort of content should be available on the platform or from the platform at least.
Yes, sure, it would be nice if such content was easy to find on the platform. But if it's all eToro produced, there may be questions of whether this is more marketing or is it genuine objective commentary.
It's a fair point, but there could be a sort of creator space, for instance, which would be shown as independent from eToro, where people could post their videos, for instance, or whatever they're producing. I think that's pretty feasible. To go back to what Andrew was saying, I think seeing who the top PIs are and the sort of risk profile that they have, or that I should say we have, also tells you something about our generation and their attitude to investing into risk in general. I found out that when I talked to my friends about eToro and they asked me what kind of returns they could expect if they copied me. And, my usual answer is the same as I give on eToro, which is, trying to outperform the S&P, which, hopefully should mean over the long term something close to 20%. There's a lot of disappointment. People expect to give me $500 and have twice that at the end of the year. And I think that's something that goes beyond eToro. I think that's a whole generational change when it comes to what can be done with money. We've all seen that we can get 10,000% returns on a dog coin. And I think that's fundamentally changed the way our generation behaves with regard to investing and money in general.
I think you make a great point because there's actually that dichotomy between you're talking about speaking to your friends and they're all really much higher risk mentality than you are. Whereas when I speak to my friends, I have difficulty getting them onto eToro because they're actually so low risk. They see eToro as quite risky compared to having their money in a savings account. And that's their problem is they're risk averse. So I think you've got people at both ends of the spectrum, and that's where eToro's got a challenge marketing. How do you do an advert that attracts people who want to make thousands of percent on crypto or whatever it may be, meme stocks, and also attract people who are really looking for something that's not much riskier than a savings account, but just gives slightly better returns. And at the moment, I'll give you one other anecdote, which again, feel free to edit out. But I was doing a filter of low risk investors, and technically that's 0 to 2. So essentially it's just 1 and 2. And if you do that filter, you get Olivier, as you might expect, you get a gent called Bhavesh Patel. But other than that, if you start clicking on these people, you actually find they aren't low risk at all. There are people who have maybe their accounts are dormant or there's a glitch in their stats that you can try it for yourself and have a look at it. But you will find great difficulty finding any person with a risk score of 1 or 2 that is truly low risk. Just try that filter and you'll see what I mean.
That's the beauty of eToro. If they can achieve that, they're sort of like bridging the gap between those two communities, the crypto community and the sort of like low risk community. And you can see people, there's people I know, who joined the platform because they wanted to invest in Bitcoin. And then they saw PIs and they started learning about the stock market and about investing. And now, they have a portfolio which is split between crypto and PIs. And I think that's a great place to be. And conversely, if we could have some lower risk people to join and copy a few PIs, and then why not buy a little bit of crypto to give a kick to your returns. And then you sort of see two ecosystems learning from each other, and I think that's a great place to be, and I think that's where eToro needs to be.
I'll tell you what's actually probably the best thing about eToro is it does allow people to access all of these different asset classes under the one roof, and potentially a person could have their own stock portfolio, a PI portfolio, commodities, cryptocurrencies. They could have it all in one portfolio, copy portfolios as well. There's so many different products that eToro offers, and I've personally got 2 eToro accounts, but it's, even if you had one account, you could trade it all under the one roof, and there's very few sites. Well, there are no other sites where you could do all of that I've just described all in the one place. So as an all-rounder, I think eToro is absolutely the top investing platform.
Yes, we're talking about how eToro might want to think about building the brand longer term. Let's talk about what that might look like. Can we foresee advertising that is more inclusive to low-risk people, showing families, mummy and daddy, both investing in the kitchen work surface, teaching their 17, 18-year-old son about investing, and eToro being the platform for that?
Yeah.
And then Granny appears and tells us that her copy of Wesley's going very well. Thank you very much. That's one way they could go, rather than continuing to appeal to young male 20 or 30 somethings, which I think we all agree seems to be more the focus than elsewhere.
I'd love to see that personally. And they have an incredible resource, which is the PIs. The PI program is something that's very unique to eToro. I think that would be a key selling point. And getting PIs to talk in their advertising, for instance, could be a good idea, and give that message of your money is safe with us.
Yes, real people I think they should go with as well. Yeah. Real PIs, real copiers, if they can get them, to talk about their real life experiences, rather than I'll probably be talking in the forthcoming episode to someone from eToro about this, but the advert I see most often on YouTube where they show the sort of the interface and there's the guy doing keepy ups, then he kicks the football over and somebody grabs it. The voices of that just sound so unreal. It's not the real actors' voices. They're these real sugar-coated voiceovers, and it just doesn't seem real. I think they need to go for realism.
Yeah, those are great ideas. I would maybe just add, so far the platform has been about opening the space for new inexperienced investors to participate in the investment world and entrust other more experienced investors to manage their money. But I think the next stage might be to actually try to empower individual investors to learn through the platform and to grow stronger as investors themselves. And I think, as the platform matures, this would allow, some of the typical behaviors that we're seeing now in the platform, which is trading and over trading and just short-term thinking, to morph into something that is closer to real investing, which has to do with long-term outlooks, with compounding. And then I think the power between, being a copier and a PI, and the power of this relation can really flourish in its fullest, because copiers would be more encouraged to stick through thick and thin and develop a relationship with a PI, which is a long-term relationship, which is a relationship where the PI is not just another stock to trade, but it's kind of like a life partner, and it's a journey that you are embarking on together for the long term. I think this would be super beneficial both to the PI community as well as to the investors community. So if I was to advise eToro on branding, I would say, okay, the first phase is, okay, let other people do the trading for you. You just relax and enjoy life. That's perfectly fine, and that can still work. But then the next stage is, there is so much knowledge in the platform. There's so much sophistication in the new talents, the PIs and everything, that you can actually tap into that, and this can have a very strong impact on your life. It's not just about making money, but it's also about adopting a new way of thinking about money, about investing, and this can sort of spill over into other areas of life. And I think that can be something that other platforms aren't really offering.
Yeah, if I could just say a few words, I think that eToro would do well to listen to your recent episode with Rihanna, where she raises a lot of good points in terms of, first of all, how does eToro attract stay-at-home mums, which she, I believe, is at the moment, and her friend she said she was talking to. Second of all, coming onto the platform, helping people in her position to learn the features of eToro and become more confident as an investor. And in the third stage of her journey is becoming a PI herself one day, hopefully. So that would be the ideal journey of someone who maybe wasn't on eToro, attract them to there, get the person confident in investing, and then in years to come, and I mean years, not months, like some people seem to be doing, evolve into a PI once they feel confident, and that would be a great growth journey. And that's kind of what I did, or trying to do myself with eToro. It's also what I did when I started playing online poker, is to start with the basics, you become more confident, and you just build yourself up gradually to higher and higher level. And so really, you can make a career out of eToro, but it's just getting that onboarding done right and the initial stages. Otherwise, people can be put off very easily if they have a bad experience.
Well, we look forward to seeing what direction eToro does move in and which PR message they think will serve the brand best. Ours not to reason why, ours but to do and make consistent long-term profits. That's the goal, and I think we scored a hat-trick in this episode thanks to our lethal attacking front three of Hugo Manenti.
Thanks for having me. It was a pleasure to speak, and hopefully there'll be other pleasures.
Gasper Soapy.
Yeah, thanks, Gavin. I think this is golden. I'm just trying to think if I was a copier, this is incredibly valuable. You have my full support. This is also a learning experience for me. I tend to be overly critical to myself, but just listening to Andrew and Hugo and yourself, I'm super amazed. So thanks.
Well, thank you, and thanks indeed to Felix Felix.
Thank you, Kevin. It was great to be on the show, as it was before, and I hope that your listener base continues to grow. I think it's a fantastic podcast, and look forward to hearing the remaining episodes in Series 1.
Well, thank you, gents. And thank you, listener, for being part of this very special Total eToro episode. That's all from me. You can continue the conversation on Discord and Facebook. If you like this podcast and want to see it continue, you can do your part, if you haven't already, by recommending it to just one person, or indeed an entire group of people this week. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything you hear in this podcast is for entertainment only, not financial advice. Do your own research. This is just generic chit-chat. We don't know your individual circumstances, etc., and so forth.